Welcome again, dear students and scholars. We now begin diluted EPS under ASC 260, and our first method is the Treasury stock method. Basic EPS used actual common shares only. Diluted EPS asks what happens if certain potential common shares become real shares. In this lesson, we focus on options, warrants, and similar rights. The memory anchor is simple. Assume exercise, assume repurchase, and add only the net extra shares. Here is the path for today. We first identify potential shares, then assume exercise, then calculate the proceeds, then assume those proceeds are used to repurchase shares, and finally add only the incremental shares to diluted EPS. Do not rush this sequence. Treasury stock method errors usually happen when students skip the repurchase step and add the full option or warrant shares. Diluted EPS exists because basic EPS may not show the full possible effect of a company's capital structure. Basic EPS uses actual shares outstanding. Diluted EPS adds potential common shares, but only when those shares reduce EPS. This is the conservative view, but it is not a free for all. ASC 260 does not allow us to include instruments that improve EPS. Dilution must actually dilute. The treasury stock method applies mainly to options, warrants, and similar rights that allow holders to obtain common shares at a specified exercise price. If the exercise price is favorable compared with the average market price, the holder would have economic value from exercising. That creates potential dilution. Convertible debt and convertible preferred stock are different animals, so we leave them for the if converted method in the next video. The method can be remembered in one line. Assume the instruments are exercised, assume the company receives the exercise proceeds, assume those proceeds are used to repurchase shares at the average market price, and add only the net shares. Think of it as a round trip. Shares go out, some shares are bought back, and only the shares left outside increase the denominator. The core formula is incremental shares equal shares assumed issued minus shares assumed repurchased. This is the heart of the treasury stock method. The gross shares from the options or warrants are not automatically added to diluted EPS. First, we reduce them by the shares the companies assume to repurchase. Only the remaining incremental shares enter the diluted EPS denominator. The first step is assumed exercise. We treat in the money options or warrants as if they were exercised during the period. That creates two inputs, the number of shares assumed issued and the proceeds assumed received. If the instruments were outstanding for the full period, the assumption begins at the start of the period. If they were issued during the year, the assumption begins from the actual issue date. The next step is assume proceeds. Proceeds equal the number of options or warrants assumed exercised multiplied by the exercise price. This exercise price comes from the option or warrant agreement. The higher the exercise price, the more proceeds the company is assumed to receive. But remember, under the treasury stock method, those proceeds do not sit idle. They become the fund used for the assumed repurchase. Now we use the assumed proceeds to repurchase common shares at the average market price for the period. This detail is important. We use average market price, not the ending market price. If an exam gives both numbers, it is probably testing this choice. Average market price is the repurchase price because diluted EPS reflects the period, not just the last trading day. An instrument is in the money when the exercise price is below the average market price. In that case, the assumed exercise creates proceeds, but those proceeds are not enough to repurchase all the shares assumed issued. So some net shares remain, and those net shares dilute EPS. For example, issuing shares at $20 and repurchasing at $50 means the company cannot buy back every share it issued. Out of the money instruments work the opposite way. If the exercise price is above the average market price, assumed exercise would create enough proceeds to repurchase more shares than were issued. That would increase EPS, which is anti-dilutive. ASC 260 does not allow that result in diluted EPS. So out of the money options and warrants are excluded. Do not force them into the denominator just because they exist. For options and warrants, the numerator usually stays unchanged. There is no interest expense to add back and no preferred dividend deduction to reverse. The effect is normally only in the denominator through incremental shares. This is a major difference between the treasury stock method and the if converted method. Options and warrants usually change shares. Convertibles may change both earnings and shares. Now read the example facts. There are 10,000 options outstanding. The exercise price is $20 per share. The average market price is $50 per share. Since $20 is below $50, the options are in the money. That means we apply the treasury stock method and calculate incremental shares. The task is not to add 10,000 shares blindly. The task is to net the assumed repurchase first. Step 1 is proceeds. 10,000 options multiplied by the $20 exercise price gives assumed proceeds of $200,000. This number becomes the repurchase fund. Good exam discipline means showing this step clearly. If you jump directly to incremental shares without calculating proceeds, you increase the risk of using the wrong market price or adding the wrong share amount. Step 2 is the assumed repurchase. The company uses the $200,000 of assumed proceeds to repurchase shares at the average market price of $50. 200,000 divided by 50 equals 4,000 shares. So although 10,000 shares are assumed issued, 4,000 are assumed bought back immediately under the method. Step 3 gives the incremental shares. Shares assumed issued are 10,000. Shares assumed repurchased are 4,000. Net incremental shares are 6,000. These 6,000 shares are added to the diluted EPS denominator. The classic mistake is adding the full 10,000. That overstates dilution and gives the wrong diluted EPS. Now we place the incremental shares into the diluted EPS calculation. Income available to common shareholders is $600,000 and stays unchanged. Basic shares are 100,000. We add 6,000 incremental shares, giving a diluted denominator of 106,000. 600,000 divided by 106,000 equals $5.66. Since this is lower than basic EPS of $6, the options are dilutive. Before including any potential common share, apply the anti-dilution gate. Ask one question. Does including this instrument reduce EPS or increase loss per share? If yes, include it. If no, exclude it. For options and warrants, in-the-money instruments usually create positive incremental shares, while out-of-the-money instruments are excluded. Diluted EPS should never be made higher by adding potential shares. Timing also matters. If options or warrants were outstanding for only part of the year, the incremental shares are time-weighted. For example, options issued on April 1st are assumed exercised from April 1st, not January 1st, and the incremental shares are weighted for 9 months out of 12. If the options were outstanding for the whole year, no timing adjustment is needed. Now take a moment to work through the quick check. There are 5,000 warrants, the exercise price is $30, and the average market price is $40. First, calculate assumed proceeds. Then calculate shares repurchased. Then subtract repurchased shares from issued shares. Lock your answer before moving to the reveal. The proceeds are 5,000 multiplied by $30 or $150,000. Repurchase shares are 150,000 divided by $40 or 3,750 shares. Incremental shares are 5,000 minus 3,750, which equals 1,250 shares. The trap is adding all 5,000 warrants. Under the treasury stock method, only the net incremental shares belong in diluted EPS. That completes the treasury stock method. You can now assume exercise, calculate proceeds, repurchase at average market price, and add only incremental net shares to the diluted EPS denominator. In the next video, we move to the if converted method for convertible debt and convertible preferred stock, where both numerator and denominator can change. If this lesson helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building this US GAAP course with clarity and exam value.